thecasesolutions.com. Hey guys, this case is about K.Peabody, creating Elusive Profits Case Solution, Government Trading System. U.S. monetary notes and bond monetary instruments are qualified to get a few incomes because of occasional interest installments and installments from the approach toward the finish of development. To fulfill a market need, the Fed offers the chance to trade the U.S. notes, depository and bonds identical to zero-coupon instruments. For instance, a 2-year bond developing in 10 years can be traded for 21 coupon bonds, 20 of which are identified with interest installments and 1 has head installments. This cycle changes over the security into a different strip, called the stripping interaction. The Fed additionally offers inverse exchanges. For example, market players, who can work with an alternate strip on securities and return full security. This interaction is known as reconstitution, recon. Indeed, the trade is like a bank credit. Broker Kidder utilized a best-in-class PC framework, the government trader system, to record exchanges in the strip market. Brokers just needed to pick an exchange, deciding if it is a strip or recon type and the amount of exchanged, the qualities of each exchange, illumination of the monetary and authorization of staff. The GTS framework likewise permitted brokers to see the market costs in order to discover the exchange openings. To expand adaptability, GTS permits merchants to exchange were expected to begin work later on, at the current cost. Dealers had the tendency to decide to pay for the exchange of the following day or any other day. This high-level usefulness was utilized to fulfill the client's needs and to make the most out of the exchange openings. Resources are estimated at market costs towards the end of each exchanging day. Any adjustment of significant worth is recorded in the day-by-day explanation of benefit and misfortune. Likewise, with every monetary instrument, zero-coupon devices were additionally estimated on a market premise, depending on the current worth of future incomes. Even though premium-bearing revenue and notes were considered as pre-premium, the cost recorded in the market excluded the revenue generated from the last installment, hence, making it unable to completely address the current income rate later on. When selling a security, the merchant got the market cost of the security from the purchaser and gathered on the business from the installment of the last revenue without cost. Contrasts in market estimation strategies especially affected the perception of GTS regarding move exchange installments. Since the strip and recon were an impartial exchange that didn't influence the benefit and misfortune explanation, the framework had the ability to offer similar benefit on the bond with strips on the date of reclamation. The financial exchange esteem, old loan cost, and premium gathered on the reclamation date. Upon the arrival of the exchange, the framework checked the strip at a limited value, market cost, where the security was assessed at the reclamation date, so upon the arrival of the exchange, the framework would record a benefit, recon, or misfortune lines. It compared the contrast between the worth of strips on a functioning day and the worth on a recovery day, which either increased or vanished the misfortune after getting zero upon the arrival of reclamation. Internal control failure, dash. After the failure in meeting the expectations for an extended period of time, in 1992 Joseph Jett started making a consistent benefit and appointed himself to be the single representative of the annual grants and rewards. Mullen, Jett's previous director, surveyed daily reports of deals and action by state table merchants. The report portrayed Jett's commitment to the advantages of this class. Mullen appeared to be ignorant towards how ridiculously the benefits were made. Mullen, who depended on PC-generated reports from government buy and sell, neglecting to test Jett's exchanging techniques, reports, and surveys. Jokester, Peabody, and Co. had bookkeeping and control divisions to keep an eye on the real announcing frameworks and to screen other work exercises. The division additionally screened all exchanging measures. However, the brokers were not answerable for conveying their techniques to the board and administrative staff. The specialty unit regulator had the ability of giving free control and bookkeeping to the organization. Jokester's inward review office looked into Jett's exchange in 2 unique manners. The first, from January to September 1993, zeroed in just on exchanging rehearse at the zero coupon table. Furthermore, the second, from August to September 1993, checked on the public authorities' installment techniques. Between the two reviews, neither discovered any wellspring of impossible benefits. The principal group of inspectors comprised of unpracticed examiners who depended on Jet's exchanging procedures without checking his assertions, who deferred and taught the second group of evaluators to audit the installment interaction, while the subsequent review group audited and was convinced that Jet's exchanges were not appropriately assessed. In May 1993, Charles Fredo, an individual from the authoritative office, dealt with a venture supported by the Asset Committee to recognize the exchanges that were not recorded and were yet to be determined on sheet. The Resources Advisory Group related to senior leaders including Cirillo, head of Fixed Income Division, O'Donnell, Chief Financial Officer, and Carpenter, CEO of K.Peabody, zeroed in on the elements recorded on Kidder's equilibrium. Jokester's ascent in late 1993 multiplied his nearest rival, Wall Street, and the organization attempted to decrease it. GAAP permits exchanges on government protections to be permitted and revealed and determined, yet installment was permitted for a single day. Fredo called attention to the fact that there was a $1 billion forward exchanged in Jet's purview. He reached an investigator to assist him with bettering and seeing the best exchanges in the state traders' government, which incorporated the program with Mullen. Nonetheless, Jet called Fredo and chided him for calling an examiner without discussing with him. Bernstein and Jet met to examine the matter. Jet and Bernstein talked about conceivable P&L interruptions that had taken place because of the program and prompted further deals. Yet the end was that Jet's upgraded exchange didn't reflect P&L's disturbance. In December 1993, agents answered to David Bernstein, Cirillo's correct-hand man, that Kidder's ascent in balance was because of Jet's exchanging. Since the exchange is important for the equilibrium, Bernstein disclosed to Jet that he ought to exclude customary off-path towards the month's end when the fixed income division needed to try not to raise the equilibrium. This is just a sample partial case solution. Please place the order on the website to order your own originally done case solution. Thanks for watching this video. Please like and subscribe our YouTube channel. If you want any case study, visit our website thecasesolutions.com.